Hello there. Thanks for joining me for the accounting and finance coaching session. My name is Echala Okori. I'm your coach, and today I want to introduce you to IAS 2. IAS 2 is on inventory. So I want to talk about inventory. Now, the International Accounting Standard Board issued IAS 2 to provide guidance for the accounting treatment of inventory. It is a standard that prescribes the accounting treatment for inventory. You must have heard inventory, stock, opening stock, closing stock. Basically, inventory is stock. Good. Now, the relevance of this standard is to help accountants to provide a guide for them so they can be able to differentiate between some confusing aspects of inventory. I mean, to differentiate between a PPE, for instance, property, plant, and equipment, and inventory, and also to show them how it should be treated, how it should be measured, and then some disclosure requirements. Now, we're going to delve straight into the IAS 2. What is inventory? Inventory has three components in its definition. One is that it refers to assets held for sale in the ordinary course of a business. So if you're in the business of buying and selling cars, the cars that you are holding for sale in the ordinary course of your business, which is buying and selling of cars, we say that is inventory for you. Also in the production process, that is assets that are in the production process. We're talking about work in progress. You know, we have finished goods. When you do some work on raw materials, we call it work in progress. And of course, you have raw materials and supplies. So basically, when you have assets that are involved in the production process, we also refer to them as part of inventory. Then the last component of IAS 2 that I want to talk about is raw materials and supplies that are consumed in the production process. So the three components of the definition of IAS 2 inventory is one, assets held for sale in the ordinary course of business. Also, assets that are involved in the production process. And the last one is raw materials and supplies that are to be consumed in the production process or in the rendering of service. Good. Now, if you're an accountant or a user of the financial information, you will know that we have inventory appearing in the financial statement in a couple of places. And that is why this standard is very important. The first place that inventory is important in the financial statement is where you are trying to get the value for your cost of sales. Cost of sales, which we also call cost of goods sold. Usually we say opening stock, add purchases, less closing stock. So you can see that stock, as I told you, is inventory. You can see that you have opening inventory, you also have closing inventory. So in your cost of sales, you know that inventory must come in. So inventory is very, very important for you to treat correctly. Another aspect is that when you go to the statement of financial position, which we also call the balance sheet, you have your non-current assets and you also have the current assets. So when you get to the current assets, you also have stock or you have inventory appearing there. So that's another very important aspect of inventory entering the financial statement. So it must be treated right. If not, it means your statement of financial position will be incorrect. It means the value of the inventory you put in the financial statement will be incorrect. So it must be treated right. Another aspect where inventory will come into the financial statement is in the statement of profit or loss, another comprehensive income. I already mentioned cost of sales, but it can also come in when there is what we call a written down value. When you write down, you have what we call an expense. When you look at cost and you look at net realizable value and you write it down, if you choose one of them, you write down the value. Maybe it's supposed to be 60 million and then it comes down to 50 million. It means there's a written down value. Now that difference between 60 and 50 is an expense, and that expense has to be recognized in the statement of profit or loss. Good. Now let's look at the accounting treatment as prescribed by IAS 2. IAS 2 says we should measure measure inventory at the lower of costs, and net realizable value. Lower of cost and net realizable value. Now, how do you get your costs? So, I want us to get this clear. Every time you think of IAS 2, what I want you to remember basically is that the standard provides a guide that you should recognize inventory at the lower of two things: costs, 1, and 2, net realizable value. Now, let's explain what this means. What is the cost of inventory? If you are looking at the cost of inventory, the first one is the cost of purchase. The cost of purchase is the acquisition cost of that inventory. And it has to be added to, you have to add things like import duties, other indirect taxes, handling charges, and other directly attributable costs. You will add it to the cost of purchase. Now, that is what gives you the cost of purchase. And of course, that is less discount. You may receive discount, so you have to less the discount. You may also receive what we call rebate. You have to less the rebate also. So by the time you get the cost of purchase, you add other directly attributable costs, handling charges, all of that, taxes, and in other taxes, you're talking about import duties. By the time you add all of that and less the discount and the rebate, you have the cost of purchase. There's also the cost of conversion. The cost of conversion, sometimes, you have to convert some assets. It's not the way you bought it that you sell it. So if there is the cost of conversion, for example, you have direct labor affecting it, or other direct expenses affecting it as cost of conversion. I mean, affecting it directly. You can trace them directly to it as cost of conversion. You will add it to your cost. And then you have other costs. Other costs also that are necessary to take that inventory from the place of purchase to the place that it will be consumed or the place that it will be used. Take it to its present position or its present location. So we're talking of position. Position means maybe you need to do some polishing, or you need to do some smoothing, or you incur some costs to do all of this to bring it to its present position before it is sold. Then that is what we refer to as other costs. Also, location, taking that inventory to its location might involve something like transportation cost. So we talk about 3 elements that make up the cost. And I want you to be happy that you know the 3 elements that will make up our cost. The first one is the cost of purchase. The second one is the cost of conversion. And then we have the other costs. So when you have all of this total, we now have it as a cost of inventory, which will be compared to something else. And that something else is what we call net realizable value. Now, what is net realizable value? Don't forget that the standard says we should look at cost on one side, look at net realizable value on the other side, and take the lower of the two. Now, net realizable value simply refers to estimated selling price. The estimated selling price less estimated cost of completion. So when you look at the estimated selling price, maybe the selling price of the inventory is, let's say, 40 million naira, and then you less the cost of completion. What are all these costs? So IAS 2 says we should elect the lower of two things. Remember that in impairment, we say you are looking to get recoverable value. We are looking at the higher of two things: value in use and fair value less cost to sell. But when it comes to inventory, the standard says you should take the lower of two things, which is costs and net realizable value. So whichever of them is lower, it becomes the value of your inventory. It becomes the cost of your inventory. Good. Now, having known this, I want to state that usually the cost of inventory is supposed to be lower than the net realizable value. It is actually not right for it to be the other way around. Usually the cost of an inventory is supposed to be lower. So this happens, you have the net realizable value being lower when there's a problem. And this problem could be obsolescence. The problem could also be physical damage to your inventory. So it is when you have those things that the net realizable value becomes lower than the cost. And when that happens, you have to write down. It means, because if the cost is 50 naira and the net realizable value is 45, it means there's 5 naira difference. That 5 naira difference is what we call the write down. Now, when you write down, that 5 naira becomes an expense that will be taken to the statement of profit or loss. At this point, I want us to move to valuation. There's a cost formula. We know that we have to value our inventory. We value our stock. How do you value it? Apart from these ones that we've talked about, I'm talking about the cost valuation. What is the method allowed? The standard allows 2 methods. The first method is what we call first in, first out, FIFO, first in, first out. And that will be dealt with. It's a very simple bin card kind of calculation. The one that came into the store first, at that price, when you are issuing out, you have to take it at that price. The one that came in first has to go out first, and it has to go at a particular rate. So that is first in, first out. We'll look at it at another class, not this class. But I urge you to please read it up. You can go to ACCA. You can also go to ICAN videos and check them out. But before that, we'll also do justice. And I want to urge you, if you are enjoying this class, please subscribe, share, and like, and of course, invite your friends to follow the accounting and finance coach. Okay, after that, the next one that is also allowed is weighted average cost. Weighted average cost. That is also another type of inventory valuation. If you want to know the cost, you want to value your inventory. Another method that is allowed is the WAC. That's the weighted average cost, which this time the rate it applies is that of rates of average. You have to take the weighted average. We'll also do that at another class. But in the interim, you can look at it before our next class or before we treat it. Now, having looked at all of that, we've looked at all of this. What are the disclosure requirements? Let's look at some of the disclosure requirements. The first one, the policy adopted for measuring inventory and cost measurement use. It means that you have, as an entity reporting, as a reporting entity, you have to disclose the policy that management has adopted for measuring inventory, and then the cost measurement. So what is the policy you have used? Lower of costs and net realizable value. You have to disclose it. And is it periodic or is it perpetual stock taking? Which type of stock taking are you making? Is it periodic or is it perpetual? Okay, you have to disclose. Another one is the cost measurement. Is it FIFO or weighted average you use? You have to disclose in the notes to the account. Then another disclosure is total carrying amount of inventory. You have to disclose the total carrying amount of your inventory. By carrying amount, we're talking of the cost, okay? You know, carrying amount is asset, the acquisition cost of an asset less its accumulated depreciation to date. But of course, for this, we're talking about the cost. So you have to mention the total carrying amount of the inventory. Whether it is for raw materials, what is the total cost? Whether it is WIP, work in progress, you have to disclose. And also whether it is finished good, you have to disclose the total carrying amount of that inventory. Another disclosure requirement is you have to tell the amount of inventory carried at net realizable value. I've already explained net realizable value, the lower of cost and net realizable value. So if you are carrying it at net realizable value and not at cost, you have to disclose the amount. Remember that for inventory, it is not total. You have to do them specifically, individually. Good. Then if you do that, the amount of inventory written down and recognized as expense, you have to disclose the expense that you have transferred to the P&L. You have to disclose it. Then the details of circumstances that led to write down. What led to the write down? Was it obsolescence? You have to disclose. Was it physical damage? You have to disclose. And then the another one is amount of reversal of any write down which was recognized as expense. So if conditions improve and you have to do a reversal of what you've already written down, you have to also disclose. So at this point, I want to say that we have done justice to Accounting Standard 2 on inventory. When you think inventory, think of lower of cost and net realizable value. When you think of IAS 2, think of FIFO or weighted average costs. When you think of IAS 2, what do you think of? Be happy that you are applying the International Accounting Standard as an accountant in the proper treatment of inventory. Thank you. Keep a date with us for the next class. Thank you.